Hi, everybody. Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania. It's the first of the month update, and boy, do we have some excitement. Let's review first what happened in April. And you can see that people are concerned about not only higher energy prices, we talked about that last month, but they are concerned, and rightfully so, about higher gasoline prices. Depending upon where you are in the country, gasoline has jumped 36 to 42% so far in the month of April, and we're going to talk about that in a minute. But what does all that mean to the stock market? Well, guess what? Not much. In the month of March, we saw the S&P 500 down 5.31%. Global indices came roaring back. The S&P 500 was up 10.55% alone in the month of April. What you're looking at is history here. We've never seen going from such an oversold level to an overbought level so quickly, literally in the matter of about 2.5 weeks. So what does that mean for us now? Well, we like to update you on, and our theme this year has been that everything is going to perform probably better than the S&P 500 and definitely the Mag 7. You can see that commodity ETFs that we own for our clients are up, but if you are in our 401k or 457 plans, and if you're in any of our models, we have you exposure to XSMO, which is the Invesco Small Mid-Cap Momentum. You can see what that's up. The Vanguard International High Dividend, the MGMT Ballast Small Mid-Cap ETF, VTV, the Vanguard Value ETF. Now you can see that where, as of the recording of this video, the S&P's 500 is up 5.96%. I think that's probably at the top end of our range, we believe, for the year. But you can see that the Magnificent Seven, which had a big earnings week this week, is only up 1.62% when you look at all 7 stocks together in a portfolio. Now, some of the stocks are up more than others, and we've seen some big turnarounds in a couple of them, especially Google, but other stocks coming into earnings really had a tough time, Meta and also Microsoft. And so that's why you can see that the Mag 7 is only up 1.62%. So again, going with our theme this year, we think dividend stocks, as represented by the Vanguard Value ETF, are going to perform well. We think international stocks, as represented by the Vanguard's International High Dividend, are going to perform well. And we think small mid-cap stocks, as represented by XSMO and MGMT, are going to be the place to be. Let's talk about interest rates, though, because one of the things that's going on, there was a Fed meeting last week, and the Fed said we are on hold as far as declining short-term interest rates. Now, that's beginning to change our outlook for the year. We really thought that what was going to happen was that sometime by the third quarter, short-term interest rates on bank CDs were going to go down from about 3.8% to about 2.8%. The problem is sustained higher energy and gasoline prices is rippling through the U.S. economy, causing higher inflation prints. So what does that mean to interest rates? Interest rates are very sensitive to inflation, and you can see that the 10-year has floated back up to the 4.40 area. Now, we think that actually represents some value, but we're beginning to modify our outlook on short-term rates. It looks as though, because of this inflation or higher inflation environment that we're in, that short rates may not drop from the 3.8% level down to 2.8% by the third quarter or the fourth quarter, unless we began to see some, unfortunately, rather dramatic slowdown in the economy. Now, so far, earnings have been very good. The Magnificent Seven helped. Some of those stocks with the capital expenditures and AI are really keeping earnings up. And we've seen that the labor force has been a don't fire, don't hire kind of situation. And so the labor force seems to be holding together. But we are monitoring many of these calls, investor calls that companies are putting out right now, trying to figure out at what point do the consumer starts to pull back. I mean, in some situations, the consumer has already pulled back, but at what point does the consumer really start to pull back because of higher energy prices? So all the major equity markets rallied sharply in April with the news that the Iranian war is winding down. We'll see, is the war really over or not? It's all about, obviously, the Straits of Hormuz. We did see decent, if not a little bit better than expected, first quarter earnings on a lot of the large cap technology stocks. There was a period of time in March where large value was greatly outperforming the growth stocks. That's reversed with that sharp rally in the month of April. We'll see if that hangs on. Now, again, our third bullet point that we suggest you pay attention to is how long these elevated energy prices keep short-term rates pegged where they are. We've had a change in the Fed chairman. We'll probably hear in the month of June the first Fed meeting talking about their outlook and what they see happening. But right now, sustained higher energy prices are showing higher inflation, but the economy seems to be hanging together and doing very well. So again, a dramatic turnaround in the month of April. One of the old caveats that's out there that a lot of traders look at is something called sell in May and go away. And what that means is that there's been numerous studies done that if you reduce or eliminate your equity exposure in the month of May, nothing really happens until September, October, when the stock market perks back up again. We can see that happening. Now, we are not selling any of our equity positions right now or suggesting that you sell them. But what we do think is going to happen is that we could have some type of trading range. I would not be surprised that in the month of May, after a sharp rally like we had in April, that we could easily have a 2 to 4% pullback in the U.S. stock market in the month of May. That would be very normal and fit in with our outlook for this year. So I want to change gears for a second because those of you that have Schwab accounts with us, we custody most of our clients' retail investment money at Schwab. Great custodian. But many of you have exchange-traded funds or individual stock positions that we manage for you, and your mailbox got packed with proxy voting. Now, we get the same proxies. We go through them 99% of the time. Most of the proxies are about electing people on the board, electing the CPA for the company. Not really a lot of things that you have to vote for, but you should still review them and vote for them, which we do. But if you want to stop getting all the paper in the mail, you can actually log on to Schwab and in the upper right-hand corner, click to get all of the proxy mailings sent to you electronically to obviously save the trees. So if you don't know how to do it, call our office, talk to Tyler. He's a whiz at this. The number at the office is 484-350-3301. That's 484-350-3301. And if you want to stop getting these sent to you in the mail, you can shut them off. They will then be sent to you in a link electronically that you can click on, review, and vote. So that's a little bit of housekeeping. We'll be back next month, but this is the first of the month update. Everybody enjoy the nice weather, and we'll talk to you soon.